MervynAKing, The End of Alchemy, Money, Banking, and the Future of the Global Economy. Embark on a journey through the global financial system as The End of Alchemy sheds light on the private banking sector, central banks, and mechanisms that played a central role in the financial crisis of 2008. The book brings to the forefront the underlying issues of money and banking in the economy, while highlighting the importance of trust and adaptability in economic systems. By dissecting events such as international trade imbalances, radical uncertainty, and the destructiveness of debt, this summary presents crucial insights to help you understand the path towards financial prosperity and stability.
The fragile state of the financial system. The 2008 financial crisis cannot be solely blamed on the actions of the financial titans. While banks did become over-leveraged and overly exposed to the property bubble, they acted within a system that incentivized results. Investors also contributed to the instability by seeking outsized returns. The growth of indebtedness, the failure of banks, and the recession were all signs of deeper problems within the financial and economic system. Traditional bank activity funded physical assets, while the engineering of derivatives allowed for an endless supply of financial assets, tempting traders to make big bets. Cash has become a commodity, and private banks create money, backing risky long-term loans with short-term deposits. The financial system is now fragile, and a small issue can have significant consequences. The focus should not be on blaming individuals, but rather on addressing the underlying problems in the financial and economic system to prevent future crises. Money and banking in economics. The book delves into the shortcomings of the free market approach in economics that led to the 2008 crisis. The neglect of the roles of money and banking in the economy allowed for unpredictable surges in demand and supply collapses, which undermined the financial system. The private banking sector's control over money creation goes against a sovereign's power to manage and oversee its supply, adding to issues of safeguarding the supply and public trust. The book advocates for a more central place for money and banking in economic study, and highlights the importance of examining events surrounding previous crashes to construct a sound financial system. The role of economic imbalances in the financial crisis. Before the 2008 financial crisis, economic imbalances, particularly between China and the United States, were ignored, leading to a situation that was unsustainable. The savings glut in China and other countries resulted in lower interest rates globally, contributing to asset price bubbles. Despite recognizing the importance of high consumer debt levels, policymakers focused on lowering interest rates, leading to further borrowing. Misdirected investments, such as overinvestment in housing in the US, shopping centers in the UK, and export sectors in Germany, have contributed to present-day economic problems. While some politicians have acknowledged these imbalances, they continue to prioritize growth over balance. Central banks' ability to correct these imbalances is questionable, and political and trade cooperation is necessary to reduce them. The International Monetary Fund could potentially play a more significant coordinating role in addressing the issue. Embracing radical uncertainty. In a world where the future is impossible to know and outcomes cannot be measured, how do we predict events? The economic concept of radical uncertainty explains this reality that experts struggle to quantify or even imagine. This uncertainty is inherent in capitalist economies, where businesses and consumers misjudge their incomes, central bankers make mistakes, and financing ventures have unpredictable results. Feedback information may not be available for long periods, leading to financial crashes and recessions. The idea that forecasting models cannot accurately predict events demonstrates the need to embrace radical uncertainty and consider the unpredictable nature of the future. The importance of trust in solving the prisoner's dilemma. The concept of the prisoner's dilemma occurs when individuals who share the same circumstances and seek favorable results have limited options to cooperate. This behavior of taking a short-term advantage by reneging on a contract harms trust and is punished according to society's ethical standards and legal systems. Trust is a necessary part of the solution to the prisoner's dilemma. The global disequilibrium between spending and production poses a prisoner's dilemma that needs to be solved to recover from the Great Recession. The IMF can provide a venue for effective cooperation, such as ending the power of a single country to veto actions. A permanent mechanism for central banks to make short-term loans to each other to cover liquidity shortfalls can restore faith in the system. The IMF can also provide a forum for nations to agree on a timetable to rebalance their economies, thereby re-establishing normal real interest rates. By prioritizing trust and cooperation, the persistent global dilemma can be resolved. Lenders of last resort. Central banks have acted as lenders of last resort since 1873 to prevent financial institutions from facing a bank run. Walter Bagehot's classic book Lombard Street introduced the idea of supplying emergency money with good collateral, ensuring the central bank and taxpayers don't lose out in the long run. However, during the 2008 financial crisis, banks lacked enough good collateral to match central bank funding interventions. Also, the existence of LOLR can create moral hazard whereby financial institutions take risky actions relying on the central bank to rescue them. The challenge now is to plot a new equilibrium that avoids such situations. Building resilient financial systems. The proposed pawnbroker for all seasons, PFAS, approach provides a more robust framework for managing financial crises. Regulations alone cannot eliminate the alchemy involved in financing households and businesses, leading to mismatches in liquidity and good collateral. Central banks acting as PFAS, making loans against all kinds of collateral, would help banks build up liquidity insurance. Banks would pay up front for required liquidity insurance and preposition good collateral at the central bank to backstop a certain proportion of their liabilities. This system would prevent banks from profiting from government bailouts and reduce the social cost of alchemy in the system. Central banks would benefit from a clear framework within which to perform this crucial role, building resilience in the face of future financial crises.
The End of Alchemy brilliantly disentangles the complexities of money, banking, and the global economy, offering a rich analysis of various factors that led to the 2008 financial crisis. The book not only serves as a reflection on past events but also paves the way for a reformed financial future. By addressing the destabilizing dynamics of disequilibrium, radical uncertainty, the prisoner's dilemma of economic cooperation, and the essential role of trust, The End of Alchemy is a reminder for readers to seek a more efficient and resilient financial system. With central banks acting as pawnbrokers for all seasons, the transformation of alchemy in the financial system can become a reality, creating a new model of stability and prosperity for future generations.